Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for August 16th of 2021. Please see our disclaimer for important information. As we start the news you can use this week, I want to focus a little bit on the Delta variant. We've got a few charts here. I think at one point I promised that we would break this out into a separate publication or presentation, if you will, and then we had a decrease in cases, and then suddenly the Delta variant popped up in every conversation just about that I've had over the last several weeks. And so I wanted to kind of show this a few charts here just to kind of put everything into perspective. And obviously it is something that is very important that we should all pay attention to and urge everyone to be safe. And just as an aside, we just urge people, to kind of think about their own situation, their own circumstances, and also be respectful for others. But having said that, we do see in the 7-day moving averages, new caseloads are moving higher. We are seeing hospitalizations and deaths moving a little bit higher. Again, primarily, almost exclusively rather, amongst the unvaccinated folks, but those numbers are trending higher. Again, grabbing a lot of headlines, but I want to shed some perspective on this. Here's a quick look with regard to the trajectory of cases, and these are, this is the Delta wave hitting other areas. And I've talked about India. In fact, I had a chart last week that showed how India has really rolled over. And you can see that in kind of that light aqua line there, and you can see the UK line that has already peaked and rolled over, as has India, and Israel has as well. So, what we've seen in other areas is a peak. And so where we benchmark the beginning of the emergence of the new strain, you can see here that the U.S. and that little squiggly darker line is still ascending. But if you use like India and the UK as a guide, and India was very relatively unvaccinated, and so it spread like wildfire. UK, fairly high rate of vaccination, and then moved higher. Israel, same way. But by this yardstick, we're probably between 2 and 4 weeks, perhaps, of seeing this crest and begin to roll over. And every wave that we've seen to date has been cyclical, and I would expect Delta to be no different. In fact, if anything, we're getting even closer to herd immunity, and we're driving more people that haven't been vaccinated to actually get vaccinated as a kind of a preventative step for infection. But again, the point I want to drive home here is that this wave will crest, and it will begin to roll over at some point here in the coming weeks. Here's our high frequency data, and as you might expect, as we've observed in some of the data, and we've got a couple charts that follow this, our high frequency data is being impacted by Delta. You can see that clearly in most of those columns on the far right, where we have some industrial impact as well. Rail traffic, steel production, although the month-over-month data is actually still pretty positive. But when you get down into more of the retail and service-related areas like hotel occupancy, open table, TSA checkpoint, motor gasoline, and commercial flights, I mean, all of those things are kind of tracking reasonably negative at this point. And in fact, in global commercial flights, aviation travel has actually been trending down really over the last month. And you can see that clearly in the month-over-month in the TSA checkpoint and commercial flight data. So for the people that are a little bit more visual, here's just basically the state of the nation as it relates to the restaurant industry, as well as TSA checkpoint. You can see both of those kind of rolling over in similar fashion. Again, this is the impact of the Delta variant, and with regard to the restaurant industry, it also has to do with the fact that it's been tough to find workers. In fact, my wife and I were out with friends on Friday night at a local restaurant, and the restaurant capacity was only about 30%, if even that, simply because they didn't have workers, and some didn't show. Some were out on COVID restrictions or quarantines, but I think the underlying theme there is that you've seen a lot of labor challenges with regard to the service industries. And on the right-hand side, clearly TSA checkpoint data is rolling over a bit. Now, I want to caution because we're getting back into the school, we're getting back into the new school year. And so you would naturally see that roll over. And you see that in 2019 kind of trend over as summer travel begins to ebb and flow. So some of that might be related to that. So over the next few slides, I want to talk a little bit about inflation. This is something that we've been really discussing at some length in both market minutes as well as charts of the week for the better part of several months now. And I think it's healthy to kind of give you all a snapshot of where we are both on the producer side as well as the service side. This is a quick look at producer price index, or PPI, month over month. This is actually the core index, which strips out energy and food. We'll have a look at CPI, consumer price inflation, as well as the differences between CPI and PCE, which is personal consumption expenditures, which is what the Fed looks at. But right now we'll look at PPI and core PPI, and you can see that the actual numbers were ahead of expectations. And this is where we're really seeing inflation right now, is in the producer side. Not that it's not happening in consumer, but this is where it's really most pronounced. And we're seeing pricing power amongst retailers. You'll see that in a minute, really high. So these costs are being passed through the channel. And you can see on the right-hand side, if you take that trend line that was established years ago on the index, you can see that we punched through that line in a very pronounced way. And again, I do think that producer prices will come off their peaks and probably settle in above this trend line. But you can see on the left-hand side that the last few monthly prints have been fairly stout, and they've actually gone up. So here's CPI and some of the contributors to CPI, and might be a little hard to read, but I've got basically two different views here. One on the left-hand side, really just pay attention to the red bars, and those are those represent the CPI contribution from COVID-sensitive items, and these are things that are kind of like emerging through this recovery period. As you might imagine, there's cost inflation that we're seeing out of the rental car industry, new cars, so on and so forth. We've got some information on that coming, but the COVID sensitive areas that are witnessing pronounced price inflation due to the emergence of the economy. Essentially, these were areas that if you go back and look at the left side of this left-hand chart, you can see that the red was in the negative last year, and that was reflective of the shutdown. So now that we're kind of recovering year over year, you can see that there are major contributors to the consumer side of the inflation basket. And on the right-hand side, we've got really kind of a point-by-point chart here on consumer price index for food away from home. These are restaurants, and you can see that with input costs moving higher, restaurants having to pay labor more if they can find it, that they're passing along prices to the consumer. And you can see that basically restaurant prices are moving higher here in a fairly dramatic way. Here's our retailer survey from Evercore ISI, and this shows you the pricing power that retailers now have. And it continues to increase. So these are costs that they're not absorbing, and they're passing through to the end consumer. And here's another look at CPI in kind of a different vein. So here's, you can see the data points on the left-hand side. The top is the all-in CPI. The one on the bottom is the core, which again strips out food and energy, which can tend to be a little bit volatile. And you can see both of those prints are lower than where they were a month ago. But granted, they've been high for several months, but they're coming off their peaks, and you can see the influence. And this is what I referenced a few slides ago. Rent, new cars, very big contributors here. Hotel prices are going up. Hospital physician services, not as much, but again, it's those things that are on the left of that right-hand side chart are really reflective of this wind behind the sails, so to speak, of consumer price inflation. And just looking ahead, I do think that new automotive prices will be sticky at a higher level just because we have choke points in the supply chain, and you'll see the issue coming out of the semiconductor sector in just a few slides. But I do think that that prices for some of these things will come off of their peaks. I do think owner's equivalent and primary rents will remain a little bit higher overall, even though the growth rate of prices should ebb a little bit. But these are areas that I think are going to continue to witness or bear some influence on the CPI for months to come. So just as we did with the PPI, you can see the trend line of core consumer prices are moving higher than the trend line that was established, the multi-year trend line. And then on the right-hand side is kind of reflective. Again, this is just one research house's interpretation of it. It's from Oxford Economics, and I tend to agree with it. I think the argument is really going to be the magnitude when you get into the right side of that chart there on the right-hand side of this PowerPoint slide is just the degree of magnitude of drop. And right here, it shows a gradual drop off the peak. I think that's reasonable. Maybe it's a little bit more pronounced than that, but again, I still think it settles in at a level that's higher than what we've seen over really the average of the last few years. And before we leave the discussion entirely of inflation, I wanted to show this slide, and this represents from the Social Security Administration, at least with the mid-year estimates of what the cost of living increase is going to be for transfer payments in 2022 as it relates to Social Security payments and cost inflators for various government transfer payments to individuals. If we keep up this pace, the COLA, or the cost of living adjustment, is going to be really dramatic this year. And it's notwithstanding, it's going to have a fairly meaningful impact on the federal budget for next year. But it's also going to have an impact on the consumer pocketbooks. And we just got through talking about inflation, and this is why you have cost of living adjustments, is because of observed inflation. But I think the real takeaway here for a lot of folks is this type of an adjustment for people that are on fixed incomes that are highly dependent on these transfer payments. Is it going to be enough? And I think that's rhetorically, that's an important question that we should be asking ourselves and analyzing as we get into the coming months, preparing our clients and our families, frankly, and elderly folks for what's to come in their financial plan for 2022. I saw this chart from Brookings, actually republished in the Daily Shot, and I thought it was really interesting. And I won't spend an inordinate amount of time on this, but this on the left is the consumer price inflation. On the right is personal consumption expenditures. I mean, both are measures of inflation, but they look at it differently. Obviously, you can see in the different percentages in the pie graph. But the Fed spends a lot more time looking at personal consumption expenditures than CPI. CPI is the inflation that gets published in the financial press, and that's what we spend time looking at. It's actually what influences that COLA adjustment that we just saw. That's what the federal government looks at. So, let's kind of dissect really some of the key components of it. So on the CPI, 42% represents housing and rents and owner's equivalent rent. So as we see rents begin to track higher, that's going to have an influence on the CPI. And if you look at other major components, you've got transportation, and just as we've seen that, auto rentals, car sales, things like that, influential, right? Because prices have been going up. And then below that, we've got food and beverages, and we just saw in the open table numbers, and we saw in the cost inflation component that was related to food away from home, that's moving higher. Again, those are three areas that represent really almost 2/3 of the entire CPI that we know are moving higher, and will be higher for a while. And so, going back to that Oxford economics forecast, I think it does have some relevance that we'll peak in inflation, and then we'll begin to we'll crest, and then we'll begin to roll over. And the real question is how long it's going to take for us to track down to kind of this new normal level of inflation. And as you can see clearly, if you go from the left chart to, the left side of this chart to the right, you can see that housing has a much lower influence on PCE. However, medical care is much more important. You can also see that transportation has a less meaningful impact. Food and beverages, a little bit less, but not terribly so. But really where you see you see the differences in that other goods and services. And these are areas that are not primary components. And that's why the Fed uses it, because they believe it's a more diversified basket of cost inputs that helps them, that in their view, get a better view of what inflation is. Wanted to show this because this is a chart that plots the quits rate versus the average hourly earnings, and this is basically a wage versus quit. And just as I was talking a few minutes ago, that the restaurant that I went to go eat at just a few days ago was understaffed because some people just flat didn't show up for work. You can see that in the upper right-hand corner of this accommodation and food and services. So the average hourly earnings are moving higher, and this is a very loosely correlated chart. You can see that these data points are all over the place, but where you have a high hourly earnings rate, like financial activities, wholesale trade, transportation, warehouse, we haven't seen a whole lot of turnover, like voluntary quit rates there, where certainly not where we've seen it in retail trade and food services and the hospitality sector. I mean, those areas are really having trouble finding workers, and the voluntary quit rate is exceptionally high, and so they have got to turn around and offer bonuses and really jack up their rates. And so that's having a meaningful impact on the prices that you pay for those services because they literally have to pass them along. And in many cases, like hotels that are, because of the lack of supply of workers, and restaurants, they're having to make their margin up with lower capacity by charging the people that are patronizing their businesses more. So in flipping the coin from inflation to looking at household net worth, and looking at a few components here, I came across a couple of really interesting charts. One on the left is household and nonprofit net worth year-over-year change. And obviously the market has had a lot of influence on this. You can see a spike where that red kind of oval kind of identifies a current spot. So obviously net worth has picked up, and that's bled directly into consumer confidence, investor sentiment, so on and so forth. And then on the right-hand side, we have a chart that looks at single-family home costs. So obviously, for a lot of people, the house that they live in or that they own and paying a mortgage on is the largest component of their net worth, and that's moving higher. You can clearly see a jump in median home prices as reported by the National Association of Realtors. That number continues to move higher. And here's a chart of the ratio of both mean and median wealth to income, and it's broken out by age cohort. And I thought this was interesting for a few reasons, as it shows basically kind of a comparison of 1989 to 2021, or at least the estimates for 21. And as you might expect, the ratio of wealth to income goes up with age, with age group, and you can see in the upper part of this that in 2021, these ratios are indeed higher than they were in 1989, and increasingly so as you get to the older age groups. And that's the mean net worth. And so this is just a raw average of the data set that's being examined here. But what's really interesting is you go to the median wealth to income, and this is not an average, but it's rather taking the midpoint and just saying that that you've got half above and below the median line. And that number is completely different. As you can see, the numbers do go up as you get into the upper age groups. However, you have to get to basically the baby boomers and solidly within that boomer category to see a meaningful difference from 1989 to 2021. In fact, if you go to the 35 to 44, as well as the 45 to 54, the median wealth to income by age group is actually a little bit lower. And so what this tells you is that you've got the the uber wealthy cohorts that are skewing the averages, right? So you've got a very, relatively small subset of uber wealthy, where their own net worth to income has gone up dramatically, maybe the top 1%ers. Whereas if you take just the median, which smooths out those fat tails, so to speak, the numbers look a lot different. And so, the interpretation here is that perhaps, looking at, these decades that, perhaps the income growth hasn't been as strong as in previous, the net worth generation relative to income hasn't been as strong as we've seen it in prior decades and certainly in prior generations. All right, so we're going to talk about commodities for a couple slides, and you can see here in a couple of these slides, what's going on with the agricultural commodities. We've got winter wheat and we've got corn. Both of which are moving higher. You can see that very clearly in these charts. And corn itself is kind of testing a trend line here. And this is influential on the food component of the consumer price basket, as well as the food component of the PCE that we just got through talking about. And these prices are filtering through to what you pay at the supermarket. These are grains that have inputs in cereals, that have inputs in a lot of things. Corn obviously is very influential as a component of fuel additive for ethanol. And so we are witnessing, a pretty strong trend, at least in the agricultural commodities right now. Now, switching to lumber, which was much discussed about 3 months ago, we have seen almost a near reversal in lumber prices. Some of this had to do with speculation, but again, clearly we've seen more volatility in commodity prices, and I certainly don't expect them necessarily to become less volatile, just because we've got a lot of supply chain choke points, and we've got a lot of aggregate demand out there, at least domestically. On the right-hand side is a chart from BCE research, and you can see, several things here. You've got Chinese manufacturing, the PMI index for China. Now, I don't have a China chart per se, but this will serve as much of a proxy as anything for what's going on in China now. That we've actually seen a really rolling over of production. We've seen a drop off in energy demand for crude oil in China. We've seen a lot of kind of like negative near-term trends in China. We do know that they're fighting the Delta variant just as other countries are as well. Probably doesn't get nearly as much press, But if you see this plot of what's going on in China, and China is very important to the manufacturing component of global growth, and you plot that against industrial metal prices in the U.S., you can actually see a pretty tight relationship here. And so where prices remain fairly high for iron ore and some of these industrial metals, BCE is trying to make the argument, and I think it's a valid argument, that those prices are apt to come down because of the slowdown in Chinese manufacturing. Here's a quick look at gasoline stocks. They are below their 5-year range right now, and so that tends to make me think that gasoline prices at the pump are going to remain higher, and that's very important to consumer sentiment. What they pay in gas and how much it costs to fill up their tank is actually a meaningful component to their psychology. So we'll have to continue to monitor this. And on the right-hand side, this is really a global reflection from Goldman Sachs on the supply and demand imbalance. So, Delta issues notwithstanding, you can see really what's going on across the globe. And this is a little bit of a noisy chart, but really the two things that I would look at are, those two, the amber line there represents the supply, and the line above it, which is kind of that more solid blue line, represents demand. And you can see demand is above supply right now. So, if you look across a broad, swath of fuels and things like that, that the energy market remains at a deficit in terms of being able to support inflated demand amidst this kind of global recovery. And so that, again, makes me think, these two charts here make me think that we're going to see higher energy prices in the aggregate for a while. A quick look at the semiconductor industry, as promised earlier. Lead times continue to expand, and this is going to be an issue that I think we're going to be fighting all of next year too. As I just mentioned in the prior slide, demand remains really high for durable goods, still remains high even as it was very strong last year, and a lot of these products, if you will, cars, washing machines, dishwashers, they all have a semiconductor component in them. In fact, a much more dense component of semiconductors than even 5 years ago. And with these lead times expanding, it's just going to place it's not only is it going to extend lead times for the products that these semiconductors go into, but it's probably going to keep those prices a little bit higher. All right, a quick peek here at the real estate sector, and this is in residential real estate. Kind of a quick check-in on a couple of items that are important. First of all is the leverage ratio, and you can see here as home prices have gone up, as indicated on the left-hand side of this chart, that the leverage ratios have come down. So the relative value of homes has gone up, and that makes the mortgage balances lower relative to the home value. And so we've actually trended almost back down to pre-global financial crisis levels, which is really interesting. However, on the right-hand side, that represents the lot supply index from Zonda, and that continues to go down. This is again, builder sentiment is relatively high. Builders are optimistic because they know that they can build at a pretty meaningful profit with these home prices. However, the lot supply is very low right now, and that will help keep prices high and leverage ratios low. So we'll go ahead and transition into the investment markets, and here we've got a couple of charts on the S&P 500. The first one on the left represents the percent of the S&P 500 that's above its 50-day moving average. And that number continues to increase. Obviously, we continue to grind higher in this market. even if earnings multiples are going down because we're coming off of, or we're coming out of an earnings reporting season that was by any yardstick very robust. And so as earnings rise, multiples go down, even though the index values are moving higher. And we can see that, basically almost 70% of the S&P 500 is trending above its short-term moving averages, which is really kind of a sign of health. I think there's room for the index to continue to move higher with the multiples having come down a little bit. And then we transition over to the right side of this chart. You can see that the overall index, which is represented in black, is falling below the equal weight. And so, what does that all mean? So just a real quick refresher that the S&P 500 is a market capitalization weighted index. And what that means is, companies that have really high market capitalizations, Microsoft and Apple, have an outsized weight on what happens in the S&P 500. And so, as a smaller subset of very large and thus highly influential stocks moves the index higher, then those stocks will have a very meaningful impact on where the index goes. But if you look at the equal weight and then reflect on the fact that 70% of stocks are above their 50-day moving average, what we're seeing is something that at least over the last week or so has played out pretty nicely, that we've seen greater participation across the index. So those highly influential stocks, while they've been very helpful in moving the index higher over the last year, at least over the last month or so, we've seen a lot more breadth in the market as it's moved higher. I think that's extremely healthy. And you can see here the equal weight, which is, essentially, every stock in the index has an equal representation, and that number is moving higher and it's separating from the overall index. And again, I think it's an indication of just overall health in the market right now. Here's another indicator of what I'll call investor anxiety, and that's the volatility index. This is a 60-day realized volatility index that is tracked by Bloomberg. And you can see that that number continues to move lower. So we just don't have volatility. It's very interesting that we don't, despite the fact that we've had higher inflation prints, despite the fact that we have higher commodity prices, which are filtering into inflation, despite the fact that we're seeing higher rental and housing prices, and a lot of things that can drive inflation volatility, but we haven't seen that drive a spike here in the S&P 500 index. And I think there's a general consensus out there that inflation is transitory and then will come back down. I think that's true, but not to the levels perhaps where some people expect. It's just hard for me to envision volatility remaining this low for a very long period of time. And I think we just have to be prepared, not that we'll see that spike on the left-hand side of this chart anytime soon, but just that we'll see higher levels of volatility overall. Well, as we continue on with the equity markets, you can see, from these charts, the sentiment remains fairly high. Again, we have low volatility, as you just saw, and that dovetails really closely with a high degree of investor confidence. So on the right-hand side, we've got the American Association of Individual Investors, and this is their sentiment index, and so it's not quite at a sell indicator level, but it's certainly not closer to a buy. Again, I think there's upside appreciation potential in the equity markets, but you look at individual investor and sentiment, that's pretty strong right now. And then on the right-hand side is Bank America Merrill Lynch. Basically, their global wealth investment management team. Their equity allocation percentage right now is almost 65%, Again, this is just a barometer. It doesn't have, any particular tie to any particular strategy. It's just their overall equity allocation as it ebbs and flows over time is really at a pretty high level right now. So continuing that thread, Investopedia has done a survey of individual investors, about 1,000 investors. So it's a reasonable sample size of their thoughts on where the stock market returns are going to be over the next 12 months. And they did one this month. The last time they did one was March, so just a few months ago. And you can see that, particularly on the right-hand side, which represents the more optimistic views on the market, that clearly the up 5 to 10% and up over 10% expectation levels have dropped off. And so like back in March, there was a real strong sense that the market was going to rocket higher and be positive. Well, and there are a few people, as you can see on the left-hand side, that, we're a little bit less optimistic, as we'll say. And those numbers are kind of holding kind of a little bit consistent, but the optimism at the, on the plus side has definitely rolled over a little bit. And you can see that greater concentration in the up 0 to 5% and then down 0 to 5%. Those numbers have both increased from March to August. And I think that probably kind of fulfills a more of a growing consensus that we're going to be, perhaps a little bit more range bound. That equity markets can certainly move higher, as is reflected in both the 0 to 5 and the up 5 to 10 categories. But it's not going to be as robust as might have been expected back in March. Here's a quick look at our 10-year U.S. Treasury rate, and we spent a lot of time last year talking about how rates were moving higher, and that persisted into the beginning of this year. We saw a really strong rate move at the beginning of the year, and then that tailed off even as inflation was beginning to kind of rear its ugly head, so to speak. And so the perception was that inflation rates were going to roll over at some point, and this inflation was going to be transitory. So the expectation was firmly entrenched in the bond market that was going to play out, and so rates began to roll over. And really kind of interesting dynamic, and frankly unexpected. And now recently, though, with some of the data prints and the fact that the economic surprise index is moving lower, and we're kind of settling in for this long slog of higher overall inflation, and we'll obviously monitoring where inflation rates peak and when they begin to roll over. But rates are beginning to move higher off of that low, and we can see that here. In fact, you can see it beginning to bump up against that 50-day moving average, which will be an important test of where rates wind up. And so obviously they're below, I think, where a lot of experts and analysts would have expected them to be, but the Fed has been very steadfast in wanting to keep rates low. But the 10-year Treasury really has more to do with inflation expectations, and again, it's moving a little bit higher. It's kind of coming in line with this overall thinking that inflation is going to be higher going forward than it has been on the average of the last several years. But it'll be interesting to watch how much these rates move higher in the coming weeks, and certainly over the next month or two. The last chart I wanted to show you today was really related to the differential between emerging markets and developed markets. And we've been spending a lot of time on the US and on the development markets, and we know that the sentiment indicators are really strong for those right now, but there's a really strong discount that exists in emerging markets relative to developed markets. And that's identified here in this chart. And so this is basically the MSCI EM index versus the DM index. And I do think that as a lot of things do, they will correct themselves over time. And we've seen, periods where we've had discounts in emerging market values relative to developed market, like back in the 2012 to basically 2015 timeframe. But those narrowed over time, and I think this is going to narrow too. So I think investors that have positioning in emerging markets will stand to benefit as this discount narrows over time. Well, that's all we have for today. On behalf of everyone, my teammates at BKA Wealth, appreciate you listening to this webcast. Hope you have a wonderful week, a productive week, and we'll see you again soon. Take care. Bye-bye.